Greetings, everybody. Get this out of the way here, if I could. This is Jeff Scott, and welcome to this week's review. It's early in the morning on Sunday, and obviously that would mean the futures are not out. Hope everybody's having a great weekend. It's clearly summer down here in South Florida, where it's hot, humid, but a nice breeze, and could be a good day for golf. We'll have to see. I titled today, Tweet-Driven Markets, Is It Time to Sell in May? A lot of negativity out there. Trade talks, Trump. Forget the political implications, just all this talk about abortions stimulating a lot of angst as well, about blocking abortions. And then add to that, it's time to sell in May, and double tops abound, and you have a market that's ripe for correction. Doesn't mean it's going to correct, but certainly a lot of concerns. We've been down about 4.5%. Question is, how far might we go? We keep bouncing. This is for educational purposes only. Any recommendation in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. I pay for all my tools. No one pays me to say good or bad things about anybody, any companies, or any tools that I use. Trading involves risk, and you are solely responsible. I'm not going to spend any time here. These are some of the folks that I've learned from, whose tools that I use that make me a better trader. And when I do training, which doesn't occur very often, I always refer to it as the Be Your Own Guru training, as I think you're responsible for yourself, and you should be learning from people, not relying on them to make your trades. I have a lot of programs. I purposely try to remember to hide my desktop. But most of what I do is within TradeStation or Thinkorswim, using a plethora of indicators, packages that I purchased over the years, and most of my market analysis and stock top-down reviews done in HGSI and EdgeRater. And I use the tools from Superior Profit, specifically Edge and their plugins, a lot. HighGrowthStock.com is the website for HGSI. I've got no financial relationship there. However, if you hit the free 30-day trial, you can get a trial to the program for 30 days with no credit card. Under investing strategies, you'll see hundreds of videos that I've done, Ron Brown and others. Stock patterns are cyclical. Now, I'm going to sound like a broken record, but we're here. This clearly is what we feel like right now, and clearly feels like this market is going down. Why I sound like a broken record? Because over the last couple of years, every time we've said that, except in December, November, when we sold off, we took another move up to the upside. Why is it different this time? It's May. I'll show you a Hindi, and I think the markets do, but that doesn't mean a thing, and I still have to be nimble in how I address the market. So if I think we're up there, I've started to buy some puts. I've sold calls against my longs. I'm looking at stocks to short. I'll show you a couple of those today. And I've had some contra ETF exposure the last 2 days. As you can see, Friday was not a good day in the market, and not surprising, most of the green was in utilities. There was some green in healthcare, especially as it sounds like Trump is not going to push drug pricing, so that may protect pharma and biotech. And the fervor over Medicare for all seems to be dying down, which, although as a physician, surprisingly, I'm not massively against a single-party payer, or at least a single-party payer alternative. The problem that I had with ACA was there was nothing about cost controls, and that's why a lot of the discussions are now both for access and controlling cost. Let's take a look at the major markets in Thinkorswim. Let's go into maximize sell here. It's here somewhere, I promise. E-minis. So you can look at this in a good or a bad. We started here in August of 2016, and we had all-time highs come in on the April 29th. This must be a weekly chart. Let me get out of the weekly and go back to the daily. Sorry about that. We'll go to the weeklies in a second. So here was our highs. If I was to scrunch this up a lot, which we'll look at on the weekly, you'll see that there was a double top in here. And you sell double tops, and we have sold off. Now, the bullish person might say, let me get some more bars. There's your bullish top. The bullish person will talk about how we've had a massive rally, V-shaped rally. Of course, we're going to pull back, and now we're going higher. That's very possibly true. We are in a person buy signal on the daily. I think the bearish argument is we had a big move up, and we're probably going to come down at least and retest the 200-day moving average to see if it holds. And the bearish argument is going to really key about this double top. I think we've created sort of targets for when you might want to deploy your money. In my opinion, and that's all that it is, oh, I hate the tools and trades. See if it works or it doesn't work. Yeah, it didn't do what I wanted to do. All right, it's not the one I wanted. Let's look again. Yeah, it's supposed to have done it. Oh, whatever. I don't use this for much of my drawing anyway, so let's go back to the whole thing. I think I made my point about the double top already. So are we going to fail at this confluence of moving averages here and come back down and retest? I think that's the likely scenario. Number two, are we going to blast off, take out the double top and go to the moon? I think that's possible. Or are we going to bounce around between the old highs and this 200-day moving average and take a rest? And I think that would be healthy. But I think those are the three things that I'm looking for. And we'll find out as the days come by. So this is the E-minis. The NASDAQ futures look almost identical. The Dow futures pulled back into that 200. The 200 held. I think that's really important because that was the tough Monday we had, and we quickly recovered. But there too are in this range between the old highs, the 200, and have to see if they can get above this moving average where the 17 is crossing down below the 50. The Russell's been the weakest for a long time, although in a shorter period of time it had a big move up between 148 and 161. And one can see on the Russell, we've broken down below the 200. And where is support on this? Clearly we know where resistance is. So the Russell is worrisome. The VIX had a positive day on Friday, but it really has come down from its highs. But it is sitting above where it had been falling. And at worst case, it's in a neutral to rising, which is not great for the market. And the dollar seems intent on setting new highs. Probably a lot of things or new recent highs are playing into this, including Brexit and the trade war. But the dollar is strong, and you know what that means on certain metals, which we'll talk about. If you go down to the weekly charts, which is where we started by mistake, we'll go pretty quick on these. You can see from a weekly perspective, there's your double top right in here. We sold off a doji bar. That could be an indecision. Maybe we go higher here. That would be great to see for the bulls. You're sitting on what should be support down here. A breakthrough here might mean we're going to go back and retest the December lows. Let's hope not. NASDAQ looks a lot like the S&P. As you can see, the Dow's already pulled down to the 50 weekly. You've got a doji here, sort of a gravestone doji. Maybe this is it, and maybe we're going to start to go higher from here. If you're bullish, that would be nice to see. And the Russell has broken down below the 50 weekly. The 17 weekly is clearly below the 50 weekly. And the Russell's got a new sell signal. That is not good if you're bullish. And you can see the VX ran up and closed down in the lower part of its range this week. And the dollar, not all-time highs or not even multi-year highs. This is 2017 December. at 103.82, but it's marching higher. All right, let me change this back to daily so I don't forget that later when I take a look at it. All right, back to the PowerPoint. And yes, I use a lot of PowerPoints, but I use a lot of them to shorten time. They're just pictures of the market today. Daily, weekly, monthly reviews. Again, if you look on the bottom row here, first column all along is E-minis, then the NASDAQ futures, and the Russell futures, the NYSE, and then the Dow futures. And we've been in longer term uptrends, as you can see. You can see the V bottom here, and then at least in John's signal showing a sell signal on the weekly on the NASDAQ, on the Russell, on the NYSE and the Dow, not yet on the S&P. And on the daily, you could see the Russell has a sell signal, the rest have dailies. But I like looking at this chart because I can see multi-time frames and remember from a long-term perspective, it may look different than it does from the short term. I use the Q tools for a lot of different things. The Metastock and TradeStation add-ons are probably the best that I have in it, or at least as good as John Person's. They're much more inclusive. And so I use they have many more tools in the set, and I use them in combination. But you could see from this Q Edge picture that over the last 10 days in maroon, I guess that's brown, whatever, only group up over the last 10 days, two groups are utilities and real estate. So that should tell you the markets are defensive. The other defensive one is down less than most, which is the consumer staples. If you look at the last 5 days, 10 groups are down over the last week. The only positive group is utilities. And then if you just look at where the strength is in the market as we go into Friday, utilities, real estate, staples. And then communication services and discretionary is starting to make a move, which would be interesting because that's not as much of a defensive sector. Now, what's underlying this market move? You can't see it real well, but the rates are dropping on both the 10-year and the 30-year. The yield curve here has turned down again, although it's still above zero. That's the delta between the 2 and 10-year yields. The AD lines turned down a little bit here, following the market lower. You can see it better here with the AD line, the NYSE, but we're still very close to our all-time highs on the AD lines. Notice that all the bullish ETFs, you can see over here what's what, diamonds, Qs, spiders, the Russell, and transports have all turned down. And with strong dollar, falling rates, what do you expect bonds to do? Bonds have turned up and are approaching their 12-month highs. Breadth breaks lower, but not oversold. You can see the number of stocks above the 200. Now, it's funny. I drew this line a couple of years ago and said, isn't it funny? Every time we get up to this line, the market pulls back. And I had stopped the line probably where my arrowhead is. I rewrote the line after last week's video. Guess what happened? We ran up to the line and we pulled back. You can see on the stocks above the 40, we've come down. And on the 12-week new high, new lows, we've come down to the lower third. Now, markets can rebound from here, but typically they're going to get a little worse before they get better. And what I look for are this signal on during the week coming down and touching this line, because when that happens, we always get a big rally in the market. Daily McClellan, we got zero line rejects on the daily and on the weekly, at least on the daily. We've had divergences here with a rising market and falling summation index and oscillator for some time, and perhaps that's one of the things that was predicting this market pullback. Buckets were oversold, with 70% of the stocks are below the midline of their Bollinger Bands, but only 8% of stocks are below the Bollinger Bands. Give me 1 or 2 more weekdays, and you'll start to see 30 or 40% of the stocks below the lower Bollinger Bands, and then we'll have a clear-cut, maybe short-term, but clear-cut buying opportunity. Now, this is going to be a little bit controversial. My NYSE and Edge Rater fired the Hindenburg Omen signal. Neither HGSI or Edge is necessarily perfect in the characteristics, because there's some characteristics, especially the moving average, that may not be exactly the same in the definition. The fact that I have a Hindi here and I haven't had a Hindi in a long time makes me stiffen. You will not see it in HGSI. It's not a problem with HGSI, just a historical calculation difference. The other thing is, I actually, when I saw this, I said, well, maybe I need to update my list of all NYSE stocks and take out the dead ones and add the new ones. And I did that. I still get the same symbol. We're just making it on the new lows. We have plenty of new highs. So, something to keep an eye on. For those that are new, the Hindenburg Omen is something that Ian brought back to popularity. It has to do with the number of new highs versus new lows, the percentage of new highs and new lows, the moving average of the NYSE, and advancing and let's see, it's got new highs, new lows, percentage of highs and lows, advances and decliners. So we actually fired the Hindi on Friday. The Hindenburg fires in settings of entropy in the market. It often signals a correction. Typically, you get more than one. And one can be enough, but the reality is only about 1 out of 4 actually turn out to be anything more than a few percent, something to keep your eyes on. Market tone went to, it's neutral to neutral bearish here. You see some reds here and some yellows. We're looking at the Woody indicator. And the sector strength, the only one that's green is utilities, but staples and real estate are the others that are holding up better. It might be time to retire the canaries or at least redo the new ones. There's people talking about Facebook, Amazon, Apple, Netflix, and Google taking out bookings and taking out Tesla. I'll look at that, but Tesla is dying and that's going to kill this index. The index of leaders, interestingly, that I put together in March is a sideways move. So even with all the market pullbacks, 58% of the stocks in this index are still in a buy, and it's sideways. So still holding up despite the sell-off. News and earnings. When I looked at this, I think the important thing, we're going to see some FOMC minutes on Wednesday. You know, this talk about rate cut in 2019 does not seem to go away, and perhaps the trade wars are going to stimulate it. All it's going to take is Powell to say it's more likely, or somebody else, and I think the market rallies. We get home sales, energy reports, jobless claims, PMI, composite flash, new home sales, and durable good orders. We've got some Fed heads speaking on Monday, Tuesday, Wednesday, Thursday, so you could have some market moving news there. So I would put it on the moderate week of news, not a heavy week of news. Earnings, you still got some big earnings left. I was surprised when I saw this. For example, Home Depot, Kohl's, TJ Maxx, Carmart, Analog Devices, one that's on my short list, Lowe's, Advanced Auto Parts, Intuit, Splunk, Autodesk, which has been a big mover, Hibbett Sports, Foot Locker. So there's a lot of things this week. So we're not done with earnings season. Pretty much most of my holdings, which are less than normal, are done because this has been a tough earnings season. Tough market to trade as news and tweets change market by the minute. Feels like upside is less here than risk, so I've moved more money to the sidelines. There are probably some people that are going to stay out of the market until we take out the old highs. And that probably is the better part of valor. I'll try and get back in deeper as before that point. Earnings wins are rewarded, but misses on current or futures earnings or revenue are being trashed. And note, this is still a big week for earnings. Top-down review shows many more bearish than bullish picks, and while markets are not quite oversold, expect continued volatility this week. And frankly, it's been tough to play this market to the downside as much of the movement occurs in or after, in the pre-market or aftermarket. Do our usual top-down review. So now I like to jump into HGSI, especially now that it's been updated. I'll have to adjust the size because It's not set up for this monitor. All right, just about there, everybody. A couple more seconds. All right, so I start with Major Markets Plus, and I put my top-down view on it. So I got to find it. There it is. And we see with the top-down view, utilities, treasury bonds, and dollar and gold are at top. So you know this was not a great week or week ending for stocks. Small caps, semis, where semis weak. Russell 2000, transports, NASDAQ 100, NASDAQ Composite, all in the bottom third. So very quickly, because we've already talked about the market, but for those who don't know me, the market's going to determine 70% of the movement of your stocks this week. So to me, the most important determinant of what I'm going to be doing, buying, selling, holding, is going to be the market. Hence, I spend a lot of time looking at the market. So we'll start with the S&P 500. Let me just show you what's on this chart. The top line here, which is white, is the Hindenburg Omen. You can see last year we fired them for really about a month. The market was going sideways, and then the market basically died on us. So they gave us a good prediction. The bongos are a long-term buy-sell. On the weekly is green, the daily is red. That's usually what happens in the pullback in the setting of an uptrend. The third one here is my buy-sell indicator. It's something that I put together trying to match one of the things that I use in another package, but not knowing what's in the other thing. I'm just going to call it my own Jeffrey indicator, which will put a name on it and probably release it because it seems to be pretty effective. Here's the high jump when it's up at the top, especially the red candle high. I expect the market to pull back as it did. The yellow is a squeeze. Down here is my indicator again because I've been spending a lot of time with it. I like to look at it. These here are calculated on either the NASDAQ or the NYSE. You can change the setting. They're on the NASDAQ now. And these are called phoenixes. The maroon one is a deeper phoenix. These are the market giving using ARMS index and other things as a sell signal in the market. Here is a eureka. These are the opposite. These are buy signals in the market. And you can see the importance of having many of these things firing at the same time as the market was bottoming. And the last is the kahuna. The kahuna is calculated on the various thing I'm looking at, unlike the eureka phoenix that are calculated on the market as a whole. And it just shows a momentum move. So I like to look at the right side of the chart. I look down here and I see, I've got weekly bongo still up, so I'm still in an uptrend, which I am. This up here to talk about my moving averages, an 8-day exponential in magenta, a 17-day simple in green, a 50-day simple in blue, and a 200-day simple in red. That's my standard moving average package. The little dots here are the PSAR dots. I use them as part of my buy-sell signals. When I go to stocks, you'll see a dashed line or a faint line, which is the industry group, which I don't need here. And then this here, which is perhaps too thick, let me thin it out a little bit, is something you have access to. And that is the Chandelier exit, which I have it on auto. And let me just make it a little thinner here. And notice that we broke down below my stop. So I look at this, I see a stock market that sold off some. How much is it down? From the high to the low, 5.4%. From the high to where we are today, 3.5%. Not a deep sell-off by any means. We're still at a mild correction. So what is my concern? As I said before, do we have a new box here? And we're right in the middle of that box. And then what can we think can happen here? I mean, sure, this could be the beginning of a big rally here. We go up to new highs. A trade deal announced by tweet tonight sure would cause that. Continue negative tweets. Do we just break down here and go to new lows or retest lows? I think that's possible, and this December retest is kind of scary, but that might be the one that's most logical. Plenty of other areas here. Or do we just do a little bit of chopping around here, which I think is most likely? So that's the three scenarios that I'm going to be looking for, and I think that chopping scenario is the most. A break above this double top, I think lots of money comes off the sidelines. You know, maybe it's the box is down here and not, whoops, didn't want to show that, and not where I wrote it. And I'm going to be watching very closely because even a break below here is going to be concerning. And I think if we break below the larger box and break below that 200-day moving average, I think we're going to see a much deeper correction, not just the 2 more percent. So the S&P, I think, is at a critical juncture, but it may just go sideways for a while. The Dow Jones Industrial Average, very similar to the S&P 500. It pulled down to the 200 and bounced. Now it's sort of stuck in this land here. Resistance overhead, support underneath. I'd like to see it break above the moving averages or below before I make a commitment as to which way this market's going to go. And that's a couple percent range. It's not very big. The NASDAQ composite will look more like the S&P, sitting right around the 50, but the same story. You've got a box. We're going to see how long that box is here for, but right now you're living in this box. And perhaps the box go down to the 200. But are you going to go out, take out the highs on Monday? I doubt it. Are you going to drop to new lows? You could. I doubt that too. Probably going to go sideways a little bit. And then lastly, the weakest of the bunch has been the Russell. And why is it the weakest? Because it's been below the 200-day moving average for quite some time. And it has a new sell signal coming on Friday. Some of the others had buys. So it'll be interesting to see what happens. It is not a all-in, run up the margin and don't look at your charts every day type of a market. Dollar, obviously I said recent highs, but if you go back long enough to 16, 17, it had higher highs in early 2017. But the dollar's had a big move up. Safe haven in the setting of trade wars, potentially Brexit. If you look at the VIX, now for those of you who use something like TradeStation or Thinkorswim to do this analysis, yes, I can do almost all of this using those programs. The problem is I don't have to wait for screen rewrites. It's much faster here. And notice how the VIX came up, peaked here, and with the market rallying, came back down, and we have a doji day on Friday, so some indecision there. Dollar strength, what about gold? Well, gold was up here. I think gold has got a safe haven as well as tied to the dollar. Excuse me, I don't know why my dog is barking. But you can see gold is sitting on its 200-day moving average. If this was a stop, sorry. I think he sees his friend. So anyway, so I was going to say the dollar, if this was a stock with a recent kahuna, my buy signal coming out of a squeeze, I'd be very bullish on it. But I think the dollar, the dollar is going to keep gold from going crazy. And right now, you could play gold, but with your expectations being more than a $2 win, I don't think so. So that's gold miners rather. Let's look at gold itself. Yeah, gold is, and you can see sideways at best. So gold miners look a little bit better than the gold, and notice you got kahunas to the downside on gold. And then on silver, certainly nothing to chase there. Now, once I've done that, I like to go look at the industry groups to get a sense of how many are up, how many are down, who are the leading groups. So I'm going to hit the warehouse, and what I pop up here is 174 securities, meaning there's 174 groups that we follow. Now, I want to look at the ones moving up, so we'll go 2-day up. Only 14 groups were positive over the last 2 days. Okay. I'm going to look at 2-day down, or actually 5-day up, and I could see I've still got 25 groups over a longer period of time are holding up. But if I go to 2-day down, I've got 57 groups. So a lot of those groups have flipped. Look at exploration, production, internet media, communications, e-commerce, oil, gas services, banks, diversified banks, especially farming. This is like the who's who of high growth stock investing, and they all have a 2-day downside. Of course, HGS, the high growth stocks had a rough last couple of days. 5-day down on the longer time frame, 58. So this is not a market that's showing me any bullish strength. In fact, it's showing a lot of bearish strength. So if I start applying new highs and new lows using my indicator, only 6 of the groups make it to the top. But I'm going to go back to the standard one for now and take a look. So I like to right-click, change index group. So this group is up because of a deal. I'm going to change the chart and tell you what else is new on this. I've added the force index. Here's the high jump. This bar where my arrow is a viable gap up, so it uses Morales and Catcher rules and automatically paints it if it's a viable gap up. The yellow is the squeeze. This is a mobile breakout. This gray bar is the industry group. The things you're seeing here are exactly the same, including the PSAR dots and the chandelier. JAS indicator fired back here. These are pocket pivots. Here's your Eureka and Phoenix, and here's your Kahuna. So up here it tells me there was a bullish doji reversal on the daily, not on the weekly. It tells me in this group 60-40 buys and sells. One new sell signal on Friday. I can't chase this. This is a takeout. This is Crave gapping up because AP Enterprises offered to buy them. They had a positive move on Friday in the setting of a bad market, but they were up 0.08 cents, less than a dime. The rest of the group is underneath the index. I don't usually look there. NetApp and Dell Technologies. Dell Technologies has been a leader, getting extended, but it has been a leader. So not much there because it's a takeout story. Entertainment content, Lionsgate, downtrend, big reversal on Friday. I don't know if this is about stars, but look at the volume coming in, a Kahuna. On Thursday, you had my indicator and a pocket pivot, a mobile breakout. Everything turned green. 57 buys in the group, 42 sells, 2 new buys on Friday. I don't like buying things in a downtrend, but took out the prior bottom and low and reversed. Not my kind of play. I prefer things in uptrends, but it did make it to the list. Walt Disney gapped up on all the news about their new streaming service, but it's really gone sideways. Earnings are out. Earnings are rather tepid. I don't see a whole lot of growth here, and it may take some time for their new online services to make that difference. And then we get to the index, and I'll stop. Cable and satellite. Comcast did make it to my buy list. Beautiful uptrend, sideways move, couple kahunas. My indicator, mobile breakout from a squeeze, looks like it might be ready to run again. And in this group of cable and satellite, 68% are in buys. So Comcast looks interestingly. It makes money. Small dividend. Charter, Expensive stock, good earnings per share growth, then slowing down. I like Comcast better, and it's a lot cheaper. Don't know anything about Altice, but again, consider the market we're in. What a nice uptrend off of the December lows. Good earnings per share growth, much more than the PE. Mobile breakout and a squeeze on Friday. Liberty Broadband looks exactly the same way. Look at the earnings per share growth here. Lots of revenue, high multiple. Even Dish Network, I don't like the earnings as much. So I think in this list, Comcast, Altice, and Liberty Broadband C look interesting. This is what I do for top down. I just go through the top 10 lists. Steel and raw materials, this may be playing off of some of the changes in the tariffs that were announced this past week. Rio Tinto, here's the chandelier stop. I like to see a break above that, but a couple of kahunas, pocket pivot, mobile breakout from a squeeze. A break above this chandelier stop might be a trigger to go in. It pays a 9.2% dividend. Let's look at this on a weekly. Looks fine, nice uptrend. Cup, handle, ready to break out on the weeklies. Like that dividend. You always wonder if it's sustainable, but that's a nice dividend. BHP Billiton, not as good, it's pulled back quite a bit. Schnitzer, no. Now, some of this has been helped because of Vale's had some problems. And this is not a group that I really know that much about, to be honest, but I do like the Rio Tinto chart. Large pharma, I mentioned a week ago that the ASCO abstracts would be coming out. Those are the first glimpse of the data that we're going to see at the Annual Society of Clinical Oncology. For those who don't know me, HGSI is a software program. Doc is I am a physician. I am a cancer specialist. And that meeting is usually very volatile for biotech, usually to the upside. People have a tendency of presenting their good data and not submitting their bad data for presentation, especially if it's controlled by industry, what you're doing. Not always controlled. An academic center could use their own funding to do a study. But at that meeting, you'll see lots of information. On Tuesday, we saw glimpses of it. I'll talk about one of the ones that I think will be a winner in a little bit. J&J is kind of sideways here. It's in a squeeze. I'd like to see something happen before I bought it. It pays a 2.6. Merck I bought on this pullback here. It's failed at the 50 once and twice, so that's bothersome. I think Merck from a big pharma is the big winner right now. They have the leading IO drug, so I'm going to probably keep holding my current position. AbbVie is a biotech that trades like a big pharma. It's down in the dumps, or it's big pharma that trades like a biotech, rather. It has a 5% dividend here. It makes money. At some point, you got to look at this and say, how many times is it going to hit this area? And before we start calling it a double or a triple bottom, let me put a weekly and see what it's done in the past in this area. What do you think about that? You think this might be a good support and a place to start buying what's been a historically a quality biotech pharma stock with a 5% dividend? Their best cancer drug, venetoclax, just got its approval extended. It's a big one. And they also have a drug called abut. I think this is a good story. AbbVie looks interesting. Not a high growth stock, more of a story with a dividend. Pfizer, Novartis. Now, sometimes I can't say much about these companies because I have some non-disclosures that I've signed. But once something's out in the press, I don't have a problem talking about it. Integrated utilities, not my favorite place to be buying because I'm a growth stock investor. Probably the best chart I've shown you because this one's actually broken out of its cup and handle. And this is NextEra Energy, not great earnings per share growth, pays a 2.3% dividend. It's had both weekly and daily doji reversals. It's a expensive stock, and you can see in the utilities, 82% of them are in buys. Duke Energy, pull back to the 200-day moving average and bounce with a new buy signal, 5.3% dividend. Xcel Energy looks like NextEra 2.7. Wisconsin looks like NextEra 2.8. First Energy looks like NextEra 3.5. I could be a broken record. If you like safe plays in a time of a tough market, this might be a good place to hide, and you can get some good yield while you're hiding out if you don't want to go into cash. So some of these integrated utilities look good. Managed care, remember last week, a couple weeks ago, I played a quick play in United and Humana. I went back into Humana on Friday. These are stocks that were getting pummeled because of Medicare for all discussions. And then the reality is, not only would it be years away, I'm not sure we'll ever get Medicare for all. We'll probably get a public option to go with commercial payers. I don't think these guys are going away, and you can see they had a big rally off of those Medicare for all calls, and still in a downtrend, but Jeffrey indicator, a kahuna, a mobile breakout from a squeeze on Friday, makes money, 1.5% dividend. United looks good. Centene is a roll-up of has a lot of Medicaid business, and they got their new fee schedule came out. Got some earnings coming in. They're buying WellCare Group, which is when they started selling off. This has been a quality company. There's talk about Humana for Centene out there. Speaking of Humana, looks worse than United. Why did I get back in? I don't know. Kind of felt like a double bottom down here. And good fundamentals, small dividend, and I'll have it on a very short lease. Anthem, similar. So these are not growth stocks that are in upper right, lower left, upper rights, but they're stocks that may be turning around. Precious metal mining, I saw that the miners I looked at first before gold actually were on their 200 with a buy signal. 5% dividend on Newmont, that's down 20%. Maybe it's moving up. You can see 2/3 have sell signals, although 2 had a buy signal come in on Friday. Not impressed. Kirkland, if I had to buy gold, this is probably my favorite gold stock of late. It's had a nice run. It's got the best earnings per share growth. Pays a dinky dividend. Royal Gold, AEM, Franco-Nevada, at least it's broken up above its 50. Not much in the way of earnings, pays a 1.9%, but it does make money. I'm not a big gold bug right now, never have been. Clearly, if the market has issues related to Iran, tankers being attacked in the Straits of Hormuz, trade wars, gold goes up and these look attractive. Outside of that, I just don't feel the fundamentals are there. Tobacco, being a cancer doctor, it's hard for me to buy these, so I won't, but we can look at them. And you could see Philip Morris, big recovery off the V bottom, pull back to the 200, wants to run again. When I see multiple kahunas and pocket pivots in a squeeze, again, defensive play, pays a big dividend. I think this looks good if you can buy tobacco. Altria, not quite as good on the chart, but a very similar story. Pyxis, a Canadian play, no dividend, no interest, although a lot of demand. And BAT, they all look the same. This is a dividend play and nothing else. Containers and packaging, nothing above the average, so I don't look at them. Trains continue to look strong. CSX, a little pullback here. Canadian Pacific, breaking out to recent highs. Kansas City Southern, little pullback by CSX. These pay small dividends. Not my kind of stock, not a big growth stock. Now, I looked at a lot of different stocks this weekend. To the bearish side, just take a look at the things that made it to my list. So I looked at a lot of stocks, and what I do is I try and find my candidates using HGSI, and then I run them through TradeStation, looking at John Person's indicators and the Q indicators to narrow down my choices. Here are some of the things in really no particular order that made it to my sell list. Auto Home breaking down below its 50 with the mobile breakdown, the weekly bongo going red. Makes money, no dividend. I think there's a Chinese internet play. It sort of ran back up, failed at the 50, and is coming back down. That to me is an ISO failure, and I look for it to attack the 200-day moving average. Cummings, again, a lot of business in China. Doji reversals weekly and daily to the downside. Tepid earnings per share growth does pay a dividend. Again, failure at the 50. My target is that 200-day moving average. Align Technology, I just like to short this stock when the market goes up because I sure as hell can't understand its valuation. I won't short it until it probably breaks down below the 200 or I get other signals. But this was a great one to have shorted up here. I guess they make the Invisalign. 2/3 of the stocks are in sells. I'm sure it's the world's greatest company. I'm not trying to diss it. I don't know anybody there. All I know is it's 15% grower, maybe. Multiple of 70, no dividend. Dover breaking down below the 50 with, look at all these new sell signals. Weekly bongos, forces, squeeze, mobile breakdown, Jeffrey sell, and a kahuna. This market rolls over again. My target is that 200-day moving average. General Dynamics just feels like it's rolling over here at $168. Zebra Tech, this one's probably not shortable today. I'd expect it to bounce off this, but a breakdown below this 200, something I might pay attention to. Parker Hannifin is broken down below the 200. Negative earnings per share growth. Multiple of 14, small dividend, bearish doji reversal on the daily. Failed at the 200. Come down to here, potentially come down and retest those lows. It's the kind of stocks I like to short if the market continues weak. Perkin Elmore, this bothers me. This is a bingo. This is on the stock. It's a baby out with a bathwater day. If I see something green or blue come into this, I would not be shorting the stock. Deere Company, another stock with the bingo, so probably have to be careful. It's another one that gets hurt because of the China deals or non-deals. Zimmer Biomet, not much earnings per share growth, not much revenue growth, trades at a 15 multiple. Again, another stock breaking down below their 200-day moving average. Alibaba, earnings came out, they were great, and all it did was get them a doji day, and then it rolled back over. Got a new sell signal, probably wouldn't short it here because that 200 day is a natural place for it to bounce. Avigo, huge run up. I have to look at those earnings per share growth and see that they're falling down. Pays a big dividend, that's one thing. But here's what I like to buy puts on, and I have a put play on when it failed the 50-day moving average. I bought some puts. Look at the semiconductors. 92% have sell signals, 7% have buy signals. Let that sink in. 9 new sell signals on Friday. Tesla, look at it roll over. Analog Devices, it's got earnings this week, plus its target here is the 200, so probably too early. Tiffany, there's nothing underneath this. Its earnings per share growth suck, multiple of 20. Philips Van Heusen, there's that bingo, so I have to be careful. IPG Photonics, the bingo's there. Doesn't mean the bingo's going to stop it from falling. And here's something that I think, let's look at the SOX. Broke down below the 50, rallied up to the 50, failed at the 50. Let's look at the weekly. I mean, you've got, here is natural support, but the semiconductors look awful. All the red. So I can short from a close here of 190, 191 down to 182. It's about 4% opportunity in options. That can be a fair amount of money. So those were some of the things I looked at on the shorting side. If I go into TradeStation, and these are the Q tools, and I'm not going to even try and teach them to you today, but let's just look at SMH. Here it is. This is John's sell signal at the top of the market, and this is a bearish headwind that says the market's getting a lot of headwinds here, is likely going to reverse from Q. Notice that there's nothing sitting as resistance here or support here until I get down to $85 per share. Here is the daily. Again, the bearish headwind resistance right there at the top of the market. Trend line, because shorted any time against the trend line. It's broken down below what usually holds, which is this two bands right here. So it's getting extended to the downside, but I think this thing can certainly drop. And it's one of the things that I'm looking at, or I might look at this one, triple the pleasure, triple my fun, SOXS, which is the opposite. And why do I like this? This is 3x bearish on the semiconductors. I can buy a shitload of this. The problem is a 10% move is only 60 cents, so you have to buy a lot for it to make a difference. I have a new person buy signal. I've got a bullish headwind resistance. This is called a go with flow setup. A break above 624, which is where I put my buy stop at 625. This thing runs up to $859. $2 on a $6 stock is a 33% move. Just make sure you take a big enough position so that it actually equals real dollars, because you don't want to buy 100 shares of a $1,000 stock and 100 shares of a $6 stock and expect to get the same dollar return. On the long side, these were the things that I'm going to be putting on my watch list, okay? On my watch list means that they're set up in my trading system, and I'm looking for intraday signals that tell me I might want to go in and buy some more. And these include my signals, Q signals, John Person signals, and I'm looking for an indication that something is different and I want to start to nibble. So just because they're on a buy watch list doesn't mean I'm buying them. Notice how many REITs are here. Now, REITs have been strong. Now, hold on a second. I'm wondering why we didn't see them, or did I just go right over them? Okay, that's interesting that they didn't show up on the 2-day EMA. They showed up when I add my indicators to them. And there's a reason why I've got so many REITs on my buy watch list. People are chasing dividends. And let's just take a look at some of them. American Tower Group was on last week. This is why it was on last week. It pulled into its moving averages. This would have been the time to buy. Probably can still buy it. 1.6% dividend, great earnings per share growth. AIV, we're going to come back to, and I'm going to look at it in Q. Broke above its 50 in an uptrend. Good earnings coming in, then it stubs its toe. Care Trust, Cyrus One breaking out 2.9%. Iron Mountain, probably not chasing that one. Physician Realty Trust, DOC, great earnings per share, 5% dividend. Public Storage, I've liked these for a while, 3.5. VEREIT, good earnings per share growth 6.4%. Welltower Healthcare REIT 4.3%. So there's no question the REITs look interesting, and it would not be wrong to own a couple of REITs here. You get a nice dividend play. Now, what else pays a big dividend? I've been talking about AT&T and Verizon for a month now. Verizon's now off its lows. We'll have a potentially chandelier reversal. Kahuna's coming in, pocket pivots coming in, mobile breakouts from a squeeze pays a 4.1% dividend, and a doji reversal on the weekly, which to me is a very strong signal, with a new buy signal on the weekly as well. So Verizon looks interesting. I've been buying here AT&T, which has, I think, a little bit higher dividend. It's now 6.4. I have nothing against you buying AT&T here. I think these guys make sense because they're not going anywhere and they pay nice dividends. I talked about some of the managed care stocks. A couple other stocks I like. Internet-based services. COPA, COUP, seems to be breaking out here. Now, the fundamentals are kind of scary because it doesn't make money. It's a relatively young stock coming out in 2016. But what a leader. This is the weekly. Hasn't made money yet. I believe it's got something to do in the cloud. It's breaking out to all-time highs here. I like Coupa. PAGS, it broke out here. It's interesting. It's got good earnings per share growth. And then Zscaler, like Coupa, broke out this week. I actually have a position in this one. What else did I like? All right, here's my ASCO play. And by the way, last week when I couldn't remember the stock, it was Loxo. So macrogenetics. This is a small biotech that is in startup phase, essentially has no revenue or very little revenue, doesn't make any money. Oncology, autoimmune disorders, and infectious diseases. They have a drug that they just studied in advanced breast cancer against Genentech's Herceptin after prior treatment. Herceptin was a game changer in the treatment of breast cancer in a type of patient called a HER2 positive patient. It's so good that unlike most cancer drugs, we keep using it even when the cancer gets worse. We just cycle through other drugs. They compared themselves versus Herceptin and they won. It's the first drug I've seen do that. If that data holds up at ASCO, I expect the stock to pop. It popped on positive data here. It popped again at the end of this week. I think this is sort of it may be the stock that I buy some, maybe it's got some cheap options that are out of the money, and I put some away to see if there's something here. If they could get an approval for this, the stock will be bought out. Typically at buyouts, the stocks are at 5 to 7 billion. It's at 1 million. So this stock has a lot of appreciation potential. I don't think Loxo's in the database anymore, but let me just look at it. Yeah, it's out of the database. Let me see if it's in TradeStation. Problem with some of the buyouts is you can't find them again. Loxo got bought by Lilly. That's Loco. Yep, it's gone. All right, anything else here to show you before I say goodbye? I know people like it when I work out and show them how I'm going to buy a stock. Let's look at an expensive stock that I'm interested in buying. MongoDB. Why am I interested in buying this stock? Let me count the ways. Are we in an uptrend? Absolutely. We had a Bible gap up here. We pretty much held the gap, really never dropping below the bottom of the gap day. The moving averages has caught up to it. We broke above our chandelier stop, so we now have a buy signal on the chandelier. Bunch of kahunas lining up here. Pocket pivots, Jeffrey signal, mobile breakout from a squeeze. The high jump isn't too far. The bongo's red. That's bothersome on the longer term, but we'll see if it doesn't turn this week with any positive movement. It's in a group of application software. 2/3 of the stocks are positive. All right. Now I usually will go into TradeStation, go into my advanced screener. I know I like this one, so it should be here. So I look here very quickly, and it's scrunched up. I apologize for that. Here's a buy signal came in on Wednesday. These are kind of little overbought signals that come up, maybe a sense of some MACD divergence, so that's something I have to watch out for, but they're not really immediate signals. The on-balance volume is above its moving average. On the weekly, it's turning up. It's got a new signal on the weekly. It's coming out of a daily squeeze with a bunch of my impulse indicators firing. You can see here that weekly bongo's been red for a couple of weeks, and you can see that the John Person indicator is positive in all three time frames. So I like MDB. I look at it now using my Q tools, and what do I see? I see a bullish headwind support or bullish headwind resistance. So it came down, had a bullish reversal here 2 weeks ago, had a John Person buy signal 2 weeks ago. Huge volumes, I'll call that stopping volume, came in the last 2 weeks. That's pretty good. And there's no barriers above it. Oh, this is SOXS. I'm talking SOXS here. This is one that I wanted to work up. So let's look at this first. Actually, we looked at this. Let me go switch to MDB. My bad. MDB is pretty good too. So MDB would have been a better buy on Wednesday. But you could see it's got a blue new buy here. New buy here on Wednesday. Green, it's moving up. Now the problem with this, in about 10 bucks, it's going to hit some resistance, and that might be the one reason not to buy it. So I like MDB. I think there's concern about a double top. Remember, Bible gap up at a flag. The aggressive buyer might buy it here. I'm an aggressive buyer. But you could also wait for it to take out this double top. So I like MDB. Another one that I liked here was AIV. New buy, go with flow on the weekly, uptrend on the monthly. Again, you've got some resistance close by, which would be the concern. Go back and let's look at that SOX, or the ETF that's short the SOX. This is probably the buy of the week. No resistance here. A break above 625, I've got no resistance here until I get to about 850. So that's $2 on this. That's a 33% gain. So let's just start thinking. Let's work up SOXS. Obviously, we look at futures. The market matters, especially on a 3x ETF. So I would put my buy signal at 626. Where would I put my stop? The low of the week was about 546. So that's about 80 cents. That's a long stop, but I'll probably give it to him. So I'm going to put my stop at 545. Do I want to buy stock or do I want to buy options? Let's take a quick look. I assume there's options on it. That's probably almost a guarantee. All right. So I'm bullish. Looks like strikes are every dollar. So I'm looking for a 2-strike move. And I think a June date is fine. I don't need to go much further because this is something that is a short-term trade. We're bullish, so we're looking at long stock, long call, short put, bull call spread, bull put spread, synthetic. And so these are the different trades I can do, and we can play with the strike prices. Since I think it's going to run above 8, I'm going to put minimum range 2. All right, there you go. So this is the 5 different trades, 6 different trades. If I just bought the stock, you all probably seen me do this before. Stock moves up, I make money. Stock moves down, I lose money. I buy it at 621. In this case, we're going to buy it at 625. Whatever I put down, 626. I can lose 626, but I have an infinite gain. So buying stock isn't a bad idea. It's a cheap stock, but again, I have to buy enough that it's going to be relevant. What about buying a call? It's an expensive call. The call is about as much as my stop on the stock. 70 cents, that's expensive. So if I bought a call, I have infinite gains, but the stock has to move from its current price to about 674 for me to start making money. So my break even is 672. So I lose money until 672. So I have to have a 10% move before I make money. That's pretty expensive for my taste. All right. How about going short a put? If the premiums are high and I think this is going higher, why don't I just short the put? So if I short a put, all I can make is this green is my premium I collected, which is on 100 shares, $47.50. But if it drops more than 47 cents down to $5.53, which is the break even, I start to lose money. I don't like this trade. Really rich people sell puts all day long, naked puts, and that's how they make money, great returns. Think about that. On $100, I'm getting, on $552, I'm getting $47.50 return in 1 month. That's like a 9% return in 1 month, but there's risk there if it goes against me. So I don't like that risk. Well, I understand why people do it. I could do a bull call spread. And the bull call spread, I think it's going to go up to 821. So let's sell one at 8 and buy one at 6. I reduce my cost by 23 cents. So I pay 50 cents. My max profit is $150 because I'm capping my gain up here. I have to move 50 cents to be profitable. That gets me to 650. So I'm risking less because my maximum risk is $50 on 100 shares. I'm capping my profit at 150. So I'm making a 3-to-1 return. I don't mind that trade. I'll be bummed if it goes 9, 10, 11, 12, but that trade's not too bad. So I'm going to keep that around for a few minutes. What about a bear put spread? I like that put, except there's too much risk. So in the bear put spread, I'm going to cap my downside here by selling a put or buying a put at $4. So the most I could lose is $2 here. Now I'm getting paid on this put spread 42 cents. So really the max I could lose is 157.50, not infinity. I'm going to put into my pocket 42%. So I'm making about 27% return in 1 month with limited risk. That's not a bad trade. I like the return. I can live with the risk. No one says you have to keep it to completion. Then I could look at a synthetic. Now the synthetic, people know, is one of my favorite trades. Let's just talk about it. I'm buying a $6 call. I'm selling a $6 put. I'm essentially creating a position in the stock with a cost basis of 25 cents. So my out-of-pocket is nothing. It's a quarter to control a share. Not $6, not 50 cents. It's a quarter. So I can control 100 shares for a debit of $25. I have infinite profitability, which I like. But what I don't like is I've also got, I could lose my whole investment, which in this case is $650. The reason why it's not investment in infinite is the stock can only go down to zero. So that might be something to think about. So those that know me and know how I trade know that this is one of the trades that I like. Now, something is not happy with me. I probably have overloaded the system. So what I would probably do, if it lets me, it looks like it's going to let me. Why is this moving? Okay, good. What I wanted to show you was, here is my synthetic P&L. I'm paying a quarter for. And here's my long stock P&L. Let's compare the two. Don't they look alike? Here's the difference. I paid the money up front on the stock, $621 for 100 shares. I can lose all of that, but I have infinite gains. In this case, what you can't really see is break-even's got to move up a little bit to cover the cost of the trade, but I don't pay anything out of pocket, so my out of pocket's almost zero. I have significant margin risk, so they're going to charge me probably the majority of that $600 in margin, meaning I have to have it in the bank just in case, but I have all the upside. Now, what I would probably do, and those that know me know that I'm going to come in here, I'm going to edit the spread, and I'm going to do another option leg, and I'm going to buy a $5 put. What I've now done is I've now capped my risk. So for paying $12.50 up front on this new put, or 13 cents, I am able to blunt my downside risk. Now, I may actually now go back here and say, what does it look like at 550? They don't give me a 550. All right. So the trade that I would take on this would be, if the stock trades above 626, I will try and buy in the 38 to 40 cent range a option spread that will be long a $6 call, short a $6 put, and then long a $6 put. My margin requirement is going to only be $1 per share. So if I buy 10,000 shares, it's only 10,000 of margin. My cost to buy $10,000 shares is not much. Not saying I'm going to buy 10,000 shares, but 10,000. Let me just do the math. I feel brain damaged right now, so I'm just going to use a calculator. So if I buy 10,000 and I buy each one at 38 cents, you're talking $3,800 to control 10,000 shares. You're risking $10,000, so your most you can lose is 13,000. You're controlling 10,000 shares with unlimited upside. That's a big trade for most people, but that's how I'm going to take this trade if I take this trade. So that would be one way to look at, and just look at the MDB trade in here. Wow, even the synthetic long stock, well, it should be a break even. So I can buy a synthetic long for $125 to cover 100 shares. Yeah, they don't give me an option to put my own in here, which is really too bad. So if I was to play MDB, so if I buy a 135 put on top of the synthetic, I'm risking $10 on that trade. $10 on 145 stocks is about 7%. To get into the trade, I'm going to have to pay $8, which is the downside. But the stock is $145. So for $8,000, I can control 10 contracts of my spread or 1,000 shares of the stock. My break even is $153, so it has to move $8 in my favor for me to break even. The most I can risk here is $1,815. I have infinite profit potential. The only thing different here is I might be looking at a July or August expiration, give me a little bit longer time. Not nearly as easy as the SOXS because it's a much more expensive play. Lastly, let's just end with a quick look in TradeStation at the major indexes. Usually I do this earlier. E-minis, just want to show you, still in a buy signal, John Person signals, weekly sell, monthly buy, high jumps down to 77%. NASDAQ, still in a daily buy signal, weekly sell, monthly buy, 70%. So my high jumps have come down from where we were concerned, because up here, not going to work. All right. Up here, they were in the 90s. The Russell in TradeStation is actually still in a buy signal, as is the Dow. And there we go. That's a signal that's time to stop. So on that note, thank you, Mr. TradeStation, for blowing up as usual. And we'll talk to you all next week.